Stop. Close your other tabs. What I'm about to show you is not a conspiracy theory. It's not a market forecast. It's a leak. It's a protocol that was activated exactly 3 hours ago in the basements of Bank of America and JP Morgan when a wall suddenly appeared on the horizon. I saw the report. I was sitting in the room when the message came in at 6:15 a.m. Demand shock. Code red on silver inventory. In Goldman's language, that means someone has left the game. And they didn't leave through the front door like everyone else, but through the back, taking all the chips with them. Forget about inflation, the Fed, and even solar panels. That's child's play. There is only one force that is breaking the market right now, and CNBC won't tell you about it because their main sponsor is that very force. Its name is artificial intelligence, and it is, literally, devouring silver. The silicon chip that trains the neural network requires not only copper, but also silver. A lot of silver. Silver is the key component that ensures ultra-fast connection. The hotter and faster your NVIDIA server is, the more pure silver it needs. And this is where the cold mathematics of catastrophe begins. Yesterday, while you were sleeping, the largest tech giants, Apple, NVIDIA, and, according to my sources, Microsoft, began not just buying, but pulling silver out of the system. They aren't trading futures. They aren't sitting on COMEX. They go directly to the mines and refineries with a check that allows them to take the physical metal immediately. This is called direct corporate offtake. Here's what this risk model breach looks like. Let's count together. The total global supply of silver that can be quickly mined is approximately 35,000 tons. Annual industrial demand is about 18,000 tons. Demand for investment silver, coins, and bars is another 5,000 to 6,000 tons. In total, there was a deficit, but it was managed as the paper market kept the price in check. New factor. According to the calculations I've seen, building the global AI infrastructure alone to power the data centers needed to train new models will require a minimum of 5,000 tons of additional silver over the next 5 years. This is not replacing old stock. This is pure, new, unsecured demand. 5,000 tons is 25% of all annual industrial consumption. But the problem is not in the number, but in the speed. At 6:45 a.m., 30 minutes before the European markets opened, my sources on the trading floor reported. One of the largest banks, let's call it Fund X, received a demand for physical delivery. Not 10 tons, not 50, but 200 tons. At the contract price. The bank is obligated to deliver, but the bank does not hold 200 tons of physical metal. No bank does. The paper market COMEX is a pyramid of liquidity. For every physical silver bar, there are 250 to 350 paper claims. In banking risk management, this is called the phantom supply ratio. When the 200-ton request came in, the bank blinked. It has only two ways out. First, run to the spot market and buy silver at any price to cover the delivery. If it does this, the price of silver will not jump by $5, but by $50 per minute. This will trigger a margin call across all its other contracts and lead to billions in capital loss. Second, activate the cash settlement protocol. The bank declares force majeure and says, "Sorry, we cannot deliver the metal. Here is your money at yesterday's closing price." Yesterday's price was, say, $30. But the price at which a real physical bar can be bought today in Zurich is already $55. When the bank declares cash settlement, it is essentially saying, the paper contract is dead. You will not receive what you were promised. This is a rupture of reality, the decoupling mode. The price on the screen remains $30, but the real price at which the physical metal transaction occurs has gone into the shadows. It is already $55, and this gap will only grow. Why is it more profitable for the bank to close out than to trade? Because the losses from the $25 gap between $55 and $30 on a volume of 200 tons is $165 million in direct losses that it can absorb. But if it tries to buy silver on the open market to cover the delivery, it will provoke a full-scale risk model breach. This is the liquidity death spiral. The skyrocketing price will wipe out the margin positions of thousands of its clients. force it to close other profitable positions, and it will lose not 165 million, but 15 billion. That's why they chose force majeure. They decided it's better to vent steam through a cash settlement and lock in a managed loss than to detonate the entire market. But this loss will only be managed for them. For you, it means one thing. If you hold paper silver, your money is backed only by words, not by metal. And as the tech giants continue their silent run, taking the physical stock, and AI grows exponentially, the price on your screen will be a lie. The real price at which you can buy or sell a real bar will be twice as high. This is not a glitch. This is a systemic risk model breach that was written into protocols 30 years ago. And it has arrived. The end of this story will not be pretty. There will be no last-minute rescue by a benevolent regulator. We have passed the point of no return. Mathematics does not lie, and it says that the silver market, must break so that AI can continue to function. I saw 3 working scenarios in a private briefing for VIP clients. And here's what the people who actually manage capital, not just host talk shows, think about them. Scenario 1, the unicorn. Everything will be fine. 0% chance. For everything to be fine, Apple, NVIDIA, and other corporations would suddenly need to stop their projects. For them to say, oops, sorry, we overestimated the need for AI. We'll return all those 200 tons of physical silver back. This will not happen. AI is a war between tech giants for dominance in the next decade. No one will blink first. They will buy up mines. They will overpay for truckloads of concentrate, but they will not return the metal to the system because their business model depends on its availability. Scenario 2, default and cash settlement, 60% chance. This scenario has already begun. This is what happened this morning. One bank activated cash settlement, and now all the others will do the same when the time comes. This is a chain reaction. When a large holder of paper contracts sees that their neighbor received compensation pennies on the dollar instead of the metal, they will immediately rush to take their physical asset. There will be a bank panic, but not in the banks, but on the exchanges. The COMEX exchange in New York will be forced to declare a temporary moratorium on deliveries. They will call it a halt in trading to ensure an orderly market. In reality, they are simply giving themselves time to rewrite the rules to legally screw over the holders of paper contracts. Your contract, which should have given you a bar, will turn into a worthless scrap of paper, and you will get the same $30, while the physical price goes over $100. This is not a market crash. It is its deconstruction. Scenario 3, slow strangulation, 40% chance. This scenario is the most insidious and the most likely. There will be no sudden scream and collapse. There will be a quiet exit, a managed retreat. The tech giants will continue their silent run. They won't make loud announcements. They will simply take all available silver. At the same time, banks fearing bankruptcy will quietly reduce their open positions and increase collateral. You will see a low price on the screen, $32, $35, but you won't be able to buy physical metal at that price. The premium to spot, the difference between the exchange price and the supplier's price, will rise from the usual 8 to 10% to 50%, 80%, and then 100%. When the supplier's price is $60 and the exchange price is $30, the market will cease to be a market. It will be 2 different worlds, a world of paper illusions for the masses and a world of physical scarcity for those who know where to look. Here are the specific indicators you must watch. This is not a news feed. These are the numbers that show when the rope will break. COMEX inventories. Eligible shall be registered inventory. Look at registered. This is the metal ready for delivery. Once this number falls below 60 million ounces, it will be a prelude to force majeure. We are on the brink now. When large corporations take 200 tons, they take 6.4 million ounces. One such move, and we are in the critical zone. Premium to spot on coins and bars. If the exchange price is $35, but a silver eagle in your local shop is selling for $45, the panic has already begun. Once the premium consistently holds above 30%, it indicates distrust of the paper price. This is your main thermometer. Bankruptcy of mid-sized brokers. When liquidity falls, the weakest links break first. If you see a small or medium-sized brokerage house that traded futures suddenly closing due to unexpected market conditions, it means they could not cover clients' positions. This is like smoke before a major fire. New partnerships between tech giants and mining companies. Watch for news about the purchase of stakes or direct contracts for future delivery between Apple, NVIDIA, and junior mining companies. When they sign a contract for the mine's entire future output, it permanently removes that metal from the public system. Your strategy must be simple and cold, like mathematics. Don't panic, but act. First, forget about paper. If you hold silver ETFs or trade futures, you are playing a game whose rules can be changed at any moment. Immediately convert these positions into physical metal. Second, physics and only physics. You need bars or coins. Do not hold them with a custodian bank. Keep them yourself, in a private vault or safe that only you control access to. This is not a question of returns. It is a question of preserving purchasing power in a financial system that could blink. Third, diversification. Don't put all your eggs in one basket. Your physical silver position should be aggressive, but reasonable. Against the backdrop of this systemic breach, I believe 20–30% of your total savings should be in metal. The rest should be in other assets that do not depend on the stability of COMEX or Wall Street. When I left JP Morgan, my boss told me, "You're panicking too early." I replied, "I prefer to be a year too early than a minute too late." What you have just heard is a protocol that was supposed to remain secret. You have been given time. Don't waste it discussing what might happen. Use it to act. The market you see on the screen will soon cease to be real. AI is already taking the silver, and it didn't ask risk managers for permission. It just broke their model.